The Chinese economy is in big trouble. The China Housing Price Index has been going down steadily with no clear signs of recovery so far since peaking in mid 2019. This is important to China's economy because real estate accounts for between 25 and 30% of China's GDP. China's economic situation has drawn comparisons to Japan's so-called lost decades. This was a lengthy period of stagflation beginning in 1990 when the housing bubble burst after rampant speculation. You can see housing starts begin a gradual and lasting decline in the mid 1980s, and Japan's GDP has been more or less stagnant since the mid 1990s. It was a situation similar to what just happened in China. China's economic woes don't end there. This chart shows us the country's annual GDP growth since the 1960s. You can see its meteoric rise from the 1980s to the 2010s, averaging a remarkable 9% growth per year as it pulled out of poverty and became a global manufacturing powerhouse. But that growth flatlined over the past few years, stalled in part due to the real estate crisis. But the crisis runs even deeper than that. Just look at the changing habits of the Chinese consumer. Personal consumption expenditures and consumer confidence are down markedly since 2021, when the housing crisis began. This has sent the economy to the brink of a deflationary spiral, briefly dipping into deflation twice in the past year and currently sitting around negative 0.7%. Pulling out of deflation has proven difficult. Chinese consumers tend to save money more than they spend in general. As you can see here, personal consumption expenditures in China account for just 39% of GDP, half that of the US. So getting them to spend again, something that Beijing has been trying to do, is no easy task. As China's economic crisis intensified and the economic outlook worsened, foreign investors began to move their money elsewhere, causing a steady decline in foreign direct investment, further hampering growth. You can see that inward foreign direct investment began a steady decline into negative territory beginning in mid-2023. And to further the comparison with Japan, the Chinese economy is also slowed by a rapidly aging and shrinking population. In 2023, more people died in China than were born. This means a shrinking population and a shrinking economy. Here we can see the age distribution of the Chinese population in 2020. There are over 300 million Chinese older than 60 set to leave the workforce, so the country's largest age group is nearing retirement, presenting a big challenge to Chinese productivity, not to mention the society as a whole. The Chinese government has a daunting set of challenges to deal with, and they're trying. The Chinese government has announced stimulus plans including injecting liquidity into the stock market and refinancing local government debt in order to get the economy moving again. We can see the impact this has had on the Chinese stock market by looking at China A50, which includes 50 of the largest companies on the Chinese stock market. It trades on Capital.com as the CN50. After these moves were announced in September of 2024, the A50 rallied by more than 40% in just 2 weeks. These moves have stabilized the decline, but there is still a lot of trepidation about the future of the Chinese economy. This is especially true amidst the ongoing trade war and Trump's tariffs on all Chinese imports. China's exports to the US account for around 3% of the Chinese economy, which doesn't sound like a lot, but it's enough to cause major economic pain if these tariffs persist and grow. The bullish case would be that the Chinese government's stimulus plans are enough to stop the bleeding and spur economic growth again. The government has promised more stimulus and has reduced rates, which tends to boost stocks. The China A50 is highly sensitive to liquidity injections and has rebounded sharply when China accelerated stimulus efforts in the past. You can see that here in 2015 when China cut interest rates and injected liquidity, which caused the A50 to rally by over 100%. Or in 2020, when China rolled out fiscal and monetary policies to support the economy. But if Beijing increases its support for the economy today like it has done in the past through more rate cuts, fiscal spending, or stock market interventions, A50 could rally further. If an investor believes that China's economic struggles continue, shorting the A50 could be a strong trade. A50 experienced a major sell-off during the 2018 and 2019 US-China trade war, and with tariffs now rising again, history could repeat itself. If trade tensions escalate further, A50 could face renewed selling pressure. On the other hand, China A50 has been showing bullish momentum. The 100, 150, and 200-day moving averages are all sloping up, indicating that stimulus measures could be taking effect. If government support continues and consumer sentiment stabilizes, the A50 could see further upside. If the government's fiscal efforts fall short, or if the US-China trade war intensifies, then Chinese stocks could face selling pressure. On the flip side, if stimulus successfully counters tariffs and stimulates the economy, the potential upside is substantial. At Capital.com, we'll continue providing you updates on these market developments. Thank you for watching.